All right, guys, this is going to be recorded. One thing I say at the very beginning of all of these webinars is if you're not very familiar with this particular strategy and or options in general, please go back and re-watch this again, because first time through it kind of blows by you. You might miss some of the nuances. The second time through will really allow that to sink in, and you'll get a better comprehension of it, and it'll stay in your long-term memory. So this is going to be a strategy that we can use with a bullish underlying or a bullish assumption. Bullish assumption. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical market analysis. I've been trading my own money for over 20 years now, and I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire. But I am here to help you take control of your finances, manage your own portfolio, and most importantly, take control of your own risk. If you have somebody else out there that you're paying to do your investments for you, at the end of the day, you can most likely do as good of a job, if not better than that person, and you won't be paying those exorbitant fees. Even if you're in mutual funds, there's a lot of fees that are embedded in there that just don't really see, and that really kills your return on investment and your yield. Anyway, I've traded most markets throughout my career from the Chicago Board of Trade. I've traded everything from stocks, financial futures, commodities, futures, currencies, and options on all of these products. And in most market conditions, as you can see down here, that was a pretty crazy day. I do have to go over this disclaimer really quick. Any opinions, news, research, analysis, or other information contained here or material provided by ProTrader Strategies and or associate companies or employees is to be provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies for that matter. The reason why I can't give you guys a strategy or an underlying and say, hey, you guys need to throw this into your portfolio, it's a great buy, or it's a good time to put this in there, it's because I don't know your risk parameters, I don't know what's in your portfolio, and therefore it wouldn't be right for me to tell you that it is right for you if I don't know all of those things. So at the end of the day, do your own homework and remember that past performance of any trading system or methodology is not necessarily indicative of future results. Okay, this is going to be on a call diagonal spread, and the reason why we picked this strategy is, for one, it's for a bullish underlying, but more importantly, with this market that we've seen in the past few weeks, this rally up, despite the fact that we've seen a lot of gyration back and forth from a day-to-day basis, we aren't seeing volatility really expand. And if you watch many of my webinars or even the daily market commentaries, you know that I like to sell and collect a credit for my strategies. And the reason why is I like to see that theta decay and everything else happen and collect all of that premium. But when we have really low implied volatility like we're seeing right now in most markets, the probabilities of volatility going up start increasing as the days go on. So the last thing I want to do is ever sell that strategy or, sell a naked call or a naked put in front of that expansion and volatility, because that really hurts. So in that regard, this is a play on future volatility expansion and directionality of the underlying. So it's kind of like a really good time to look into this particular strategy and maybe implement it into your portfolios. And the other aspect of it is I don't really use this strategy a whole lot because the stars have really got to line up for it. You really have to do a little bit more digging to find the right opportunity to put this strategy into your portfolio. But if you've seen some of my other ones, you shouldn't allocate a vast majority of your portfolio or your trading strategies to one particular strategy. So this is just another arrow in the quiver to add into that, so that you're not always just doing call spreads or condors or things of that nature. And you can put this in there when the opportunity arises, and it's a good strategy for the long term, and it helps pay for some of that long call in the longer duration. So anyway, this is, like I said, going to be a neutral to bullish assumption on it, and technical difficulties have not seemed to abate very well. But what we're going to be doing is we're going to be buying an option that is further in duration away. So we're going to be, for instance, right now looking at June and July time frames. And what we're going to do is we're going to go in, and I am going to go start working with the platform here. So what we're going to be doing is trying to do something along the lines of, let's look at Apple, for instance. Go straight into it. I usually don't go this quickly into the platform, but for some reason my slides didn't transfer very well. Anyway, so what we're going to be doing is we're going to be looking at these calls that are relatively close to the market. And when we sell this, this is all extrinsic value. So any option that is out of the money, which that's this line in the sand, anything above 100 for the most part in Apple right now, because it's trading very close to 100, as you can see here. Anything out of the money is going to be something that, okay, Eileen, you're taken care of. Can everybody else can hear okay, right? Still? So we're going to be looking, first thing, our first step is going to be to pick the right strikes. So the idea here is picking the right strikes, okay? That's our first step in trying to determine which strategy we're going to do. So we're going to be picking the right strikes by going in here, and the first thing we're going to do is look to sell an option here, and one of these two, depending on how quickly you think this market is going to move higher. Now, if you think it's going to trend more sideways in Apple, Apple's been trending nicely up, but that would be an indication for me to move a little bit further away. If it's, you know, flatlining kind of, then I might go a little bit closer to the market, but Apple's been trending up, and if it breaks above 100, it could move a little bit higher rather quickly. So I'm going to be looking to sell something around in here, and then I'm going out to the next option cycle. And what I want to do, I don't want to buy just like the first in the money option. Some people do that, but the way that I build this strategy out is this is, like I said, all extrinsic value. Now, in these options right here, the pricing has intrinsic value and extrinsic value. This is all extrinsic value. We're going to try to pay for our extrinsic value of this particular option. So in doing so, one quick cheat that we used to use on the floor is, you know, rather than doing all the math to figure it out, is you kind of just go straight across and look at this. That, the put extrinsic value is really the embedded extrinsic value of the calls. Yes, it is a little bit off, sometimes 10 cents or so, but as a ballpark figure, we can look at this being pretty close to being our extrinsic value of the call option. So we're going to at least try and cover what this is showing, which again is what the extrinsic value is of this particular option. I actually have a tendency to like to get a little bit extra extrinsic value than what is embedded in the calls here. So I would like to have that paid for. This is, you know, it's probably closer to maybe 80 cents here, just off the top of my head. If we did the math on it, it's probably, yeah, it's very close to what, maybe, yeah, 80 cents. So as a ballpark, that's what I would look to before I go to buy this. So the idea is we're going to sell one of these for every one of these that we buy, and that would create our diagonal call spread. So as you can see, the debit we're paying, a way to add this in is you add that into the call that we are long, and that is below this $130 or $100.35. So if you add that $7 to that, that puts you at $99.95, right? So we're paying really on this call less than what it is currently trading for, and that's pretty important too, you guys. You don't ever want this debit, when you add that debit into this long call, to be more than where it's trading right there, because then your break even ends up being above where the current market is. You have to have a bit of a rally in order to achieve your break even. My break even with this to start is now below where the current market is. Okay, that's very important, and it can be confusing, but just remember, you add your debit into your long call, that ends up being your break even. You want your break even to be below where this is currently trading. Does that make sense for everybody so far? Okay, now another nuance to this strategy is picking the strike. So this debit is $7.45. What's the width of these strikes? It's $10, actually $9.50. So what we need to do for the next step, after we've come up with, we realize that our break even is below where it is trading, we need to pull up our calculator, and we don't want to pay, you know, you guys heard me say, you know, on like credit spreads, we want to collect a third the width of the strike at least, so that'd be like 33 cents on a dollar wide. So what we need to do here is figure out what our width is, and that's $9.50. We need to take $7.45, divide that by, where's my divide sign? Divide that by $9.50. And we want this to be, you know, my rule for this is 75%. We don't want to pay more than 75% the width of those strikes. So this would not meet that criteria, that particular criteria for this strategy. So that's the idea for building this out. So for everyone, first thing we do is kind of look to the options, see what we could collect here. You know, if you wanted to move it a little bit tighter, then we could go and sell this one and try and at least collect that $1.50 of extrinsic value, and that would mean that we're buying the 95 strike. So now we end up having a $6 wide, and it's a $5 debit, which is not going to meet that criteria either. But that's the idea, is to play around with it. So that's what I talked about. This one can be a little bit more time consuming in figuring out what the right strategy is for or what the right underlying is to fit this particular strategy. Another nuance with this strategy is to look over here at your volatility. This is your volatility, the Vega over here. And you want to make sure that your different option cycles are less than 2% wide. That's my other rule of thumb on this one, is that we don't want this option cycle to be 20 and this one to be 20, you know, 23.75 or something along those lines. That starts getting too wide of volatility. The reason why is that when volatility contracts, we lose our extrinsic value, and if this volatility down here contracts faster than this, then that's going to hurt us in that regard. So try and make sure that these line up relatively close. Obviously, the further out in time you go, volatility has a tendency to creep up. So having said that, we probably would not really want to go into the July-August cycle on this one, because it is a little bit wider than that parameter. Okay, so that is basically picking the right strikes. Picking the right duration. Now, the right duration on this, obviously what we're trying to do is we're trying to capture that theta decay in the front month. We want, because we're trying to build this strategy where we collect a little bit more than what the extrinsic values are showing. So when I showed you that, we were trying to collect a little bit more extrinsic value than what we were actually paying for. And if you have a net credit of just the extrinsic value, of course with this strategy we're going to be paying an overall debit, but we want to have a surplus of credit on just our extrinsic value, because when that starts decaying we start being able to make more money. Also, when you collect a little bit more of that extrinsic value, it helps you if the market starts to shoot up fast, too far, too fast. Whereas otherwise, if you were only doing it the way some people teach it, you're going to lose money relatively quickly. So this will help, increase your probabilities of success if you can collect a net credit on your extrinsic value. Does that make sense for everybody so far? I know I've said a lot in the first couple of minutes, so that's really important base for what we need going forward. So we want our short call to have good theta decay, and keep in mind we want to have our different expiration cycles being, around 2% difference, so or no more than 2% difference really. So this is a chart of the theta decay that really shows how theta starts decaying. So after 35 days, you start getting this real fast ramp down in theta decay, and that is the speeding up of the premium decay that you see in that closer or nearer to expiration cycle. So that's why we're selling that. We want to see that theta decay happen rather quickly, and then we're picking the further duration one where it doesn't decay quite as quickly. So we're right here around this 49 days and 21 days, so you can see that our front month will decay faster. That's the one we've sold. That's the one we want to see rapidly decay. And then that gives us the opportunity to have on that long call in the further duration to make money when our market continues to rally higher. And this is pretty important. We want to pick the right environment. What I'm talking about in the right environment with this one is low volatility or low vega, and we want those months again to be very close in volatility like I showed on that screen. Picking the right underlying, this goes without saying for basically everything that I trade you guys, is make sure that there is a lot of participation in that underlying, because if there's a lot of participation in that underlying, the bid asks get a lot tighter. And if you have to give up a lot of edge to get in, you're going to definitely have to give up a lot of edge to get out, especially with this strategy, because we're buying an in-the-money option. And when those in-the-money options go deeper in the money, they kind of get lost, or the bid-ask gets a little further apart. So something like with the example that I showed with Apple, there's a lot of participation in there. Sometimes it seems like those deep in the money options are a little bit wider, but because there's so much option activity at the ones that are out of the money and for quite a duration out of the money, they will have people giving up the edge on both sides when they're deep in the money. There's just a lot of participation in there. There's all kinds of different spreads people are using, so you'll be able to get filled probably a little further away from the mid price, or closer to the ask, I guess, or the bid if you're trying to get in, closer to the bid, or closer to the ask if you're trying to get out. You usually only have to give up a few pennies in Apple to get in, which is very important, because that will ultimately eat into your profits. And know your exit strategy before you're entering this trade. Now, like I said, we're looking at something that we're paying, about 75% the width of those strikes. So an easy example would be to think of it for math purposes. If it were a $10 wide spread, so like the 100 strike to the 110 strike, that's $10 wide, June to July, right? If we're only paying $7.50, then our max profit on that trade is $2.25. So that $7.50 equates to about 75% the width of those strikes, right? So if our max profit then is $2.25, then once we reach about $1.25 in profit, that's when we're going to be looking to cover this. Goes along with my, once you reach 50% of max profit potential, that's when I'm going to cover. One of the few ones that I changed that rule on is for the strata, which are the ones that are right at the money, and that's because you're collecting a big credit usually when I'm selling those, and it takes a lot longer for decay. But on this one, we're still looking for that 50% of max profit potential. And how do we find our max profit? It's the width of the strikes, like I said, minus that net debit we paid. So $10 wide, paid $7.50. Our max profit is the $2.25. Now this is very important because we're using different expiration cycles. It's considered somewhat unlimited for one reason. If we hold on to this and let our short call decay and basically expire worthless, then when the market rallies up, then we're going to have unlimited profit potential. Another difficult part about this strategy to determine max profit is how volatility is going to be affecting those different options, because the options have different sensitivity to volatility. Volatility usually will affect the further duration months more than the closer duration. So therefore, our max profit could increase even just on that spread, as the one we paid for increases in value and the one that we sold decreases in value due to theta decay. If it's offset by that volatility adjustment, then we start making more money on that because our premium gets pumped up in the back month while our premium in the front month gets decayed. So it is a general rule that the width of the strikes minus the debit paid is what it is, but keep in mind that the different expiration cycles can make that unlimited, and it can adjust as volatility adjusts. Pretty tough to meet full. Yeah, great question, Farhad. He says really good stuff, but the criteria can be pretty hard or tough to meet, and the variables can change substantially over the passage of time. Absolutely. That's why this isn't one that I've talked about a lot in my daily market commentaries. This is a strategy that you will have meet these parameters, maybe every couple of months. So this strategy isn't going to be one that is, your first go-to. But when you're looking at low implied volatility and you're trying to think of strategies to implement in that type of environment, and you're looking for volatility to expand in the future, this is a good one to start looking in there. And I'm not going to lie to you, it is difficult to find the right time and the right environment for this strategy to come in. As a matter of fact, earlier today I was looking at Apple, and I had a couple of examples that were working out, but those have since gone by the wayside, despite the fact that Apple didn't really move up at all today. I thought that was going to be a really good example for Apple. I have a couple more that we can probably try and make it work out, but it isn't the easiest one to always implement. It's not like a iron condor where you can constantly go out there and find strategy to fit the criteria, or make that strategy fit some underlying, I should say. This one is one that you're going to have to play around with, and in a low implied volatility market, go through several different underlyings and finding the right one to make it fit. Good question, Keith. Do I sell another short call once the first one expires? Yes, I do, especially in something like Apple, where those weeklies will have a lot of open interest. If it's something that, you know, the monthlies have good open interest, but those weeklies really just don't get much participation, then no, I probably wouldn't. I'd just kind of let that that long call kind of ride. But with something like Apple, yeah, I will have a tendency to roll that out in time through the weeklies and lower my overall cost basis. So yes, that is a strategy that I use. I was going to talk about that when we got to the platform, but yeah, great question. All right, so max loss on any strategy where you're paying a net debit, that is your max loss, is the net debit paid. That's pretty easy to figure out. It's going to be whatever your net debit paid is. And again, for the break even, I kind of mentioned this earlier, it's your long strike price, which is going to be that further duration month, plus your net debit paid. And volatility can, again, affect that break even. But remember, we always want, when we build this strategy, to have that break even be below, slightly below where our underlying is currently trading. We don't want that net debit to be, or that, sorry, yeah, that break even to be above where the strategy is trading. Yeah, I thought I was, but yeah, Keith asked, you sell another short call when the first one expires. And yes, that will be something that we do when we have an underlying that has a lot of participation in the weeklies. If you're doing something where we're going even further out in duration with that long call, that ends up being more along the lines of a poor man's covered call, which I've done a webinar on it and have the rules around that one. And that's to try and have that option for free, which is kind of along Keith's line. You continue to roll those out. This is going to be closer to expiration than, say, a poor man's covered call. So, all right, so let's get back to the platform, and good question, Barrett. What do you do if the option goes into the money? As long as, you know, you've paid or you've collected a net credit for those calls, you know, these out of the money, or these calls out here will increase in value faster than the ones that you have that are in the money. And the reason why, as you can see, the deltas are very different from this example of Apple. If we were to have implemented this one, the deltas are different. So I'm short 44 deltas and I'm long 20 or 73 deltas. So that's 29 deltas that we are actually long. So for every dollar move, our overall portfolio on this strategy is going to increase by 29 cents. This one's going to, the overall strategy will increase by 29 cents to the profit side. So that's how you can tell where you're at with that. The delta tells you for every dollar increase, this one will increase by 73 cents. This particular strike will increase by 73 cents. So for every dollar increase in the underlying, meaning that if this goes from $135 to $101.35, this premium will increase by 44 cents. So this increasing by 73 cents, by this one increasing by 44 cents, then we are going to be gaining 29 cents for that underlying moving $1. Does that make sense? Would I cover the short call first? Probably not. I don't generally do that. Eileen has a question. What is that? What do you do on expiration day? If that, hopefully we're letting this expire worthless. That would be the ideal situation. If it is in the money, then I'm going to cover it. And I might cover it a few days ahead of time just to make sure that I'm avoiding any assignment risk on it. Does that make sense? Because I don't want to get assigned on this. Does that make sense? It does not make sense. I'm not going to allow, what is the max loss is going to be your debit paid. The debit paid you at origination. So for instance, my max loss on this particular strategy, if I were to do it, would be $5.04. Anytime you're paying a debit, that is going to be your max loss. Your max profit is the width of these strikes, which would be $6 minus that $5. So $1 is my max profit on that. This doesn't necessarily meet the criteria that I was looking for. So let's find one that was kind of going to meet that criteria. I was looking at, I think and I don't like to pay a lot for them, so Apple may not be the best example anymore, because it's looking like in order to achieve this, I'm going to have to sell the 105s. If I sell the 105s to get that, so if I were to sell the 105s, let's try this one. Or no, I wouldn't want to do that. I can't do that. So the 105s is 40 cents. I'm going to have to pay like by the 90s. So if I'm going to sell the 105s, let's say, to get a little bit further away, I'm going to sell these 105s for 40 cents. So now I have to pay for that extrinsic value, try and at least collect that extrinsic value, and I like to collect a little bit more credit than that. So I would probably buy these 87.5 calls to get that to work out. So what's the next step we do? We look at this. We add the $12.73 to 87.50, and that puts us at 123 cents, right? I'm doing that off the top of my head. So 123 cents. So our break even is 123 cents, because remember, it is the long call, which is, this is my long call, plus the debit added into the $87.50, and that comes out to 123 cents, right? So the width of those now we have to figure out, which is from 87.5 to 105 off the top of my head. That's going to be 1250, 1750, right? So we got to bust out our calculator again and clear. So the $12.73 that we paid for this, and it is a difference of, what did I say, 1750? So divided by 1750. So 72%. So that would meet the criteria. It is, you're paying $12.73, which is a little bit more expensive than some people like to pay, but that would meet the criteria. And the nice thing about that, it gives you about $5 to the upside in Apple to move, rather than selling these ones that are really close to the at the money. Do I have a, yes, I usually, you know, I would cover this for a loss. This is a good question. Do you have a point at which you lose confidence? Anytime I lose confidence, and that could be right away. Anytime I get that gut feeling like I don't know if I like that trade anymore, that is when I cover the trade. It doesn't even have to be a monetary thing. You know, it doesn't have to necessarily meet a rule. Usually if you're looking at a strategy and it's going, you know, you're not liking it, then, you know, that's probably the first inclination to cover it. But having said that, you know, if you're a probability type person like I am, the probability of these 15 calls being in the money at expiration in the next 21 days is 17%. The delta tells you the probability of that strike being in the money. The probability of the market coming up and touching that, just like touching it, in the 17% probability of this strike being in the money is by 1 penny. But the probability that this market will go up and touch 105 and maybe bounce off, but just go up and test us, is the probability of testing us is twice the delta. So that's what, 34% probability that the market will come up and test us on it. So keep that in mind. So if you're probabilities and like to play with probabilities, keep that in mind as well. Just as this, the probability of this strike being in the money in 49 days is 90%. That's a 90% probability this will be in the money. But on the flip side, you know, there is a 10% probability that it won't. And when we double that probability, that means that it has about a 20% probability that the market could come down and test that. So if it does go down here and look like it's going to test, you know, touch my strike here, and it does it rather quickly, I'm going to immediately roll these down to the at the money strike, whatever that is. So that's going to be closer to, you know, probably 92.5, and try and collect about another $1.50 to increase my break even, or to lower my break even, lower my overall net debit. So you know, that's how you start defending that this type of strategy, is to roll that down. And like I think it was Keith mentioned earlier, the other option is to continue to roll that out in time through these, because if we look at these, you can see that there's a pretty tight bid ask, and if we go in here and look at our overall volume and open interest, you can see there's a lot of volume in there just today in these weeklies. Over here, there's a lot of volume in here as well, but you can even go further out and look at quite a bit of volume. I mean, there's a lot of volume at the 100 strike there, so there's a lot of open interest throughout here, throughout these weeklies. So you can rest assured that you can easily get in and out of these and roll it out in time. Does that answer your question? Yeah, you don't want it to go too far. Dom's asking, I wouldn't want my underlying to go too far below my break even, right? Yeah, that's right. I mean, you don't want it to go too far below there. So if I was going to, I usually look at it like, you know, on the smaller ones, like if I'm doing $3, it's once it goes to $6, that's what I'm looking to get out. So double that. So double what I initially paid is where I'm looking to get out. So if I paid $3, I'd look to get out at $6. You know, when you're starting to look at $12 debit on something, you know, I'm a little less inclined. to take that much of a loss. I'd probably start looking to cover it when it was at like 18, let's say. Like half of, take half of the debit, add it on there, so when it's at 18, that's when I would look to cover it, and or defend. If I still felt like I was directionally positive with this, I would look to try and roll down and defend it that way. What's the difference between volume and open interest? Good question. The volume is what happened today. So all of this is what happened today. These 15,000 contracts on the 100 calls traded today. And this was the open interest. That means what is outstanding. So on Monday, this will show the open interest as being, very close to 16,694, because this is now new open interest. I mean, that's a rule of thumb. It's not exact. Don't get me wrong. It's not, some people could have been covering trades as this guy was getting in, but that's the idea. Did I say buy a long put? Would you buy a long put to hedge long call? I don't like to, because then, that decreases my profit potential. I try to roll it down, sell calls in order to collect more credit, which in turn lowers my break even. If you all of a sudden decided, this was going to go down, then if you buy that put, you're increasing your break even away from where you are, because you're paying out more money. I don't like to do that. I would, and if you're buying that put, you're pretty sure this is going to go down. At that point, I would probably cover the strategy and maybe buy a put, because then my mentality has switched. As soon as that mentality switches, get out of it, you guys. I mean, I don't care what price it is. It could go down $2. It's just because maybe you saw a technical thing or something or other. Or, you saw the new iPhone and were like, this thing's junk, or something like that happened, and that mentality switches. Immediately cover it. Don't second guess yourself. Don't talk yourself into being originally right necessarily. Just move on. If you start questioning yourself, move on to something else, and that goes for anything. Okay, so I mentioned a non-cash method for covering your short. I'm not sure what I said there to lead you to believe that, but a non-cash method. If I said that we would want this to expire worthless, that is basically that we get to keep that premium we originally collected for financing that longer duration contract. And that would be the perfect scenario, is that Apple just slowly starts rallying up, and in 21 days it's trading at $1 and $104 and say 98 cents, right? If we had sold that 105 call, that's going to expire worthless, and that would be the perfect scenario, or because we're going to collect all of it, and or and then we would get that full max profit on the upside, because then that underlying is rallied that much as well, and our deltas have superseded on the rally. And then basically that's when I'm going to kind of maybe even hold on to that particular call. Oh, I said not necessarily using cash. Well, anytime you're doing options, you're doing you're on margin for some of them. I don't remember saying anything about that, but you're not always using all cash for this particular strategy. As a matter of fact, the only amount that you have at risk is the debit paid, and that there is no margin in that. Okay. Answer everybody's questions up to this time. All right, let's go through a couple more examples because Apple on this one, that would work. So this particular one would work. You end up paying a lot for this strategy for the amount of money that we're going to make because you know, you can only make so for instance, where I would cover this, let's go over that. So we went over this. The width of the strikes is $17.50. So our max profit is $4.23, right? So I'm going to be looking to cover this right around $2 on the profit side. So if I can make $2 on this strategy, then that's where I'm looking to cover it. If the short gets tested, if my short call gets tested on the upside, I'm going to let it go, and or you can look to cover it. If it happens really fast, then the slower it happens, the slower this market rallies to come up to test me, the less likely I'm going to be nervous because it's just a slow rally, and that's what I want to see. If, you know, because at the end of the day, I do kind of want to get tested because that means I'm directionally right. If as soon as I put this strategy on right away and it comes up there fast, then I'm maybe going to take it off, but usually I just leave this strategy on because I know the probability of this coming up and testing me at least once is 34%. So probability of testing me is 34%. So that's a pretty good probability that I'm going to come up and get hit on this. Leon's asking, is this being recorded? Yes. And I know this is heavy. This is a heavy strategy to take in. And there's a lot of stuff that goes on. It's one of the reasons why I've kind of held off really talking about it. I've wanted to have some of the newer students or participants to get a better hold on options before we really got into this. And we've done a lot of webinars on figuring out delta, or what delta is, what gamma does, what theta does, what vega does, and how it affects all of these options prices. So, you know, I knew this was a heavy strategy to take in, so it kind of held off on this for a little while and decided to do it because it's one of the better ones, to be quite honest, in this type of slow grind up in a market. So, you know, this is a perfect strategy for a slow grind. You know, when everything else is kind of boring. You can't sell strategies in this environment. Or collective credit, I should say, in this type of environment, and you have to pay a debit. So the idea here is to pay as little as we can for this premium and hope that we get volatility expansion. Okay, so let's go to a different example, and Leon's asking how to explain the different, how to select a particular option. So let's go to LinkedIn. And, you know, I usually say throw out your guys' stocks. I'm not going to do that today because we're kind of running close on time. So I found a few that I think will work out. Hopefully it will. All right, so wait, what am I doing? I'm having a brain fart. I can't think of what LinkedIn symbol is all of a sudden. Linked, right? I guess, I don't know why that didn't work. All right, so I thought I pressed that in the first time. Bull put spreads and bear call spreads. Yeah, Eileen, somebody can hopefully click in there and help you out with that. So while the short is getting tested, the long is making money, which counters the short. Is that right? Yes, Trevor, it is, because of that delta difference. So when we're selling this this short call, so for instance, let's look at this one. So LinkedIn, you know, I do have this is like what I like to see with this kind of underlying. Just a boring rally. It just keeps trudging higher. That's the kind of market I want to see for this strategy. Low implied volatility. This is implied volatility. I mean, really low implied volatility. And when we go to the trade page, if you look down here, this is where you find, I have every option open. Low implied volatility is at the bottom here. So scroll down here, 15% low implied volatility. I want this ID percent to be below 30 for this particular strategy, because that gives me the probabilities that it's going to expand for me. So with LinkedIn, as you can see, I got one extra one open there, 29%, 29.5%, 31.5%. You know, I mean, that's close enough to the 2% in my eyes to do this. You know, if you really wanted to, you could. LinkedIn probably has enough volume and open interest. It's kind of wide there. And keep in mind this bid ask always gets a little wider after the closes. So, but you might be able to go there and get that a little bit tighter even. So, but first thing I do is I look at this along the lines of, you know, this, you know, if we could sell the 40 somewhere inside of the 40 call, which is easy to do, obviously. So I would look at somewhere right around, let's say this $2.30 strike. So that's going to be the one I'm going to sell. And then I need to finance my call with this money that we just sold. We're collecting $3 or $2.31. So I want to pay less than $2.31 in extrinsic value. So that's basically saying this 125 strike has $3 in extrinsic value. And if you subtract $3 from $9, you got $6.65. You add $6.65 to 125. That gives you 131.65, right? 131.65. So it's over. So I need to go a little further down to this one, $1.78. So if I look to buy this one, you know, that $10.90, add that to the long call, gives us 130.90, and that's below. Our break even is below where the current market is trading, which is what we want. Now we have to go in and say, with our calculator, unless you can do this math in your head, take the $10.90, $10.90 divided by the width of these, which is $14. And that gives you 77. Bummer. Oh, it was working out earlier. So I did the 120 and 133s. So that doesn't work out. So let's try to go a little bit closer, the 133s. $10.50 in that. So now we got $13 wide with the $10.50. So $10.50 divided by, oh, sorry guys, I pulled up my phone to do this on. Something's not right there. Let's try this again. So if I'm doing the, buy the 30, or sorry, sell the 33s to get a little bit more credit, and then buy, sell the 33s to buy the 120s, gives us $10.50. That one for some reason was working out earlier today. So that one's not going to fit it either. So, you know, again, the difficulty of getting this to nail down can be difficult. Let's go to Schlumberger. Schlumberger was working for me too. So I had And sometimes if the nearer don't work, then go to a little bit further out in time, and you can try that one also. So this is getting to be right inside that 45 days that I usually talk about, where you start seeing that theta really come off. So in the next couple of days, this, you know, by Monday, this one is going to be right inside that high volatility or high theta decay area, where it really slopes off. And then we got August, which is 84 days out. So if I go out here and look at this, Schlumberger $5 higher approximately, and I say let's just go to the 80s, $3. It's kind of all over the place. I wish I really could have gotten that LinkedIn one. I'll look at LinkedIn again on Monday, and if it works out, I'll do that strategy, and I'll talk about that in the daily market commentary. So we go here, selling that one. We want to pay less in extrinsic value than what we're receiving. So that's about this 70 strike. July, August. So what did I do before? I did the 80, about the 67.5. So let's go to this one. So add in again the $9.22 to 67.50. That gives us what is that? 76.77. So it's less than. All right, so add in, so that meets the criteria. The other thing is to go $12. Pull up this again. Yeah, I know it oh, I closed my it does make it difficult. The higher the debit paid, it's more difficult to manually find the perfect sweet spot. Yeah, this one takes more time than most strategies. But it is a good one, especially in something like where you saw LinkedIn just slowly trudging higher. This is a really good strategy for that low volatility, boring market. So so $9.22 divided by the difference, which is $12.50. So 73. So this one would work out. And it gives us a little room to the upside for the next few days. So the idea, we'll go over the criteria again, Trevor. I'll do it right now before we have to go. The criteria is, you know, one, our idea is that we want to find the right strikes. And the right strikes is making sure that, you know, you're picking the strike that you want to sell where you're comfortable. So that's the one you want to start with, the one that you're comfortable selling and having it expire out of the money. The next step in picking the right strike is knowing that there's a lot of open interest in here, and Schlumberger being you know, a $77 stock, only 4 cents wide. That's good. I say anything, and I don't like to use this strategy with anything over 100. The sweet spot for strike prices is right around $50 to $70. You know, you can go a little bit lower, but anything over $100, it really gets harder and harder for me to implement this strategy, because our debit is increasingly higher. You know, something like Amazon, you're going to be paying a ton of money for this. And with Amazon having wild moves, you know, you have to have a lot of intestinal fortitude to handle that kind of thing. So finding the strike that we're comfortable with. The next step is finding the strike over here, which is the call, but this is extrinsic value. This is extrinsic value because it's out of the money puts, but that also gives you a really good indication as to the extrinsic value of what's embedded in this particular strike. So that's, rather than going through all these strikes and figuring out what the intrinsic value is and extrinsic value, rest assured that if you're collecting more here than you are here, you are covering the extrinsic value. Okay? And that is the goal to set this up, to start. Because if we collect more in extrinsic value than we pay in extrinsic value, if the market moves up really fast, we have a higher probability of not losing money, or a higher probability of success. It also creates a situation where our break even is lower than the current market is trading. So our break even is, we're already setting ourselves up for success because our break even is actually below us at the initiation of this strategy. Then the next step to figure out is this price that we're paying less than 75% the width of the strikes, meaning $9.22 divided by $12.50, that's less than. Right now I'm calculating the percentages right here. So by talking about so first step, collecting more than the extrinsic value we're paying is the first step. The next step is once we get our debit paid that we're going to be paying, the $9.22, we need to figure out if it's less than 75% the width of the strikes. And to do that, you take your debit paid and divide that by the $12.50, which is the width of the strikes, right? 67.50 to 80 is $12.50 equals 73. So it's only 73% the width of the strike, which is less than 75. That works. Okay. And then our max profit is that, the difference also. So, our max profit is that $12.50 minus the $9.22. So our max profit on this trade is $3. So in that, I would cover this strategy at about $1.80 profit, which is about 50% of that, right? Okay. Well, I gave you guys a lot to think about on a long weekend, so you have that going for you. Any other real last questions? Good. Do you cover it if you're wrong with direction? Yeah. So in this regard, like $9 and, I usually say double that debit, so it'd be $18, but that's a lot of money to lose. So the closer I get to 10, if it's like $3, if it's below $5, I usually say I'm going twice the loss there, and that's usually because that small underlying has moved a lot more. On this one, I'd probably look to cover this at about $13 and maybe $14, because I'm looking at about half of that. So $4 or $5 on top of that. I'd look about half of that. All right. It takes a lot of work to get this one. It does, and it takes a lot more work than any other ones. But in low implied volatility, in my eyes, that everything's a lot more work. And when there's high volatility, everything seems to come a little bit easier, especially for me, because I like to sell premium, and volatility has a tendency to come out faster than when you have high implied volatility. It has a tendency to come out really quick, and so you can make really quick hits. When there's low implied volatility can last for a while. So That's why this strategy, we're trying to take advantage of some time in order to let volatility come into our strategy, which is what we would like eventually to have happen, is we get some volatility expansion happening and those premiums go up and we can make some money. Okay? Low volatility, anywhere, but it doesn't have to be between 30 and 15. I used a lot of examples right around that 15-ish area. But like Schlumberger, if you can see over here, only has a 5%. Anything below 30 is usually where I'm going to be looking at this. But on this strategy, like when I have high implied volatility, I'm looking at high implied volatility strategies. I go up to the top of this list because this is all implied volatilities. I put in the watch list by going to the gear and typing in implied volatility %, and then I sort it from high to low. So if I'm looking to sell premiums, which my rule is above 50, and I've got that many strikes to work with, and I basically already have all of those in my portfolio, then low implied volatility, I just scroll to the bottom and work my way up. I'm not going to do this strategy with Google because you're going to be paying a lot of money unless you got really deep pockets. And there's a lot of, Google doesn't have a lot of high implied volatility %, but it still has big moves. Okay? Don't do this in high implied volatility ever. So start at the bottom and work your way up, and you know, it's going to take a little bit more work than most strategies to find the right setup, but once you do, then it's a pretty good strategy. All right, that's all I got for you guys today. I appreciate you guys sticking around on a holiday weekend. I'm sure everybody wants to get out and enjoy the extended holiday, and maybe a lot of you guys have some place to go. This is the option special we are offering right now. It's got a lot of stuff in there, and a lot of you guys, especially if you're newer traders, may want to look into this. Let me pull up the actual web page. Because you get a lot going on. I show you how to set up my screen, like with that watch list stuff, the deltas, what that means. You know, most people say there's only 4 things that delta measures. You know, it measures your hedge ratio, it measures your probability of being in the money, and it tells you how much the underlying is going to affect the price of that delta. You know, the delta move is going to affect the price of that particular strike price. But it also tells you, like I said, that, you know, probability of being tested, which is, you know, an old floor trick we used to use. Just like the old floor trick we used to use on figuring out what your intrinsic value is, rather than trying to do all the math in your head. You just look at the puts and say, all right, well, that's the extrinsic value for the puts. That's basically what the extrinsic value of the calls is, without having to do the math. You also, with gamma and how gamma affects the delta in your option prices. So basically you get all of these in one package. So that's a really good deal. So you guys can check that out. There's a link right there in the chat box, so you don't have to copy down the link or anything like that. You can just go to that link that's in the chat box. It's not in this questions box. It's on the other little chat area. All right. The other thing is you guys can follow me on Twitter, especially during earnings season. I tweet out what trades I'm doing. You have to decide whether or not that trade for earnings is appropriate for you. It may not be, but I do also have other comments on there as well. So you can follow me at Wolfman's blog. And in later webinars, we're going to be drilling down on different option components and how to trade these options, trades I find, and when and where I find them appropriate. I also do that on the daily market commentary, so please check those out. It's about a 10-minute video that I do daily that I talk about each individual trade that I'm looking at. If I'm making money, how I'm defending it, why I put it on, why I'm taking it off, and when I find it appropriate, so you can check that out. This is also the link for that special offer if you miss out on that, and from the chat box there, and you rewatch this later and decide to find it, you can copy and paste that. And please reach out to us if you guys have an option strategy you want me to cover. Go and please write to us at trading@protraderstrategies.com and give us that idea. I'd love to cover it and help you guys out with that. Or you can call us at 310-598-6677. Another thing is if you guys have signed up for the services and you have an issue with a particular strategy, maybe it's testing you, it's going against you, or maybe it's a winner and you want to know what my rules are as to what I would do around that particular situation, I would be happy to share that with you if it can possibly help you out going forward. All right, that's all I got for you today. If you can't take that, take it easy. Thanks again, Rick. Good to see you back. Thanks, Trevor, everybody.